The deficit totaled $1.7 trillion. The federal debt is above $30 trillion. It's the largest in the world. Currently, the debt to GDP in the U.S. is above 120%. According to this table, the U.S. occupies 34% of global debt. What is the government going to do about it is my question. David?
Well, first of all, I'd say that if you look at that image, it's $2 trillion because of the way they played with the student loan debt forgiveness. So the deficit's basically going from $1 trillion last year to $2 trillion this year, which is, again, I think it's just inexcusable that that's happened. And people want to know why the economy has been doing well. Well, that's actually your number one go-to right there. So yes, I think it's a huge problem.
These numbers are so big now that people don't really sit down and think what they mean. But reality will assert itself, and at some point, for some reason, the financial situation of the United States is going to matter because the dollar is the reserve currency, and everybody's invested in that, whether they like it or not. If they consume energy, they've got dollars on their balance sheet, and so $33 trillion in debt is going to matter. And I would think more importantly, in the short term, this $2 trillion that Dave is talking about heading to $4 trillion is absolutely going to matter, probably more so than the $33 trillion in debt. And when it does, it will matter a great deal for the stock market. It'll matter a great deal for the bond market, particularly the treasury market. It'll matter a great deal for the dollar.
We have a very special panel with two very distinguished guests breaking down the biggest risks that investors face today and into 2024. Stay tuned. First, a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. We have a special panel with two esteemed guests, David Hay, a regular on the show, Co-CIO of Evergreen Gavekal, and Grant Williams, host of the Grant Williams podcast and author of Things That Make You Go, Well, gentlemen, good to see you both, and honored to spend 30 to 40 minutes with both of you. I'm excited to get Grant on the show. David and I worked together many times, and he's spoken very highly of you, so thank you for being here. Welcome.
Well, listen, that just proves you can't trust what David Hay says if he speaks highly of me, but it's always nice to see Dave. I enjoy every chance I get to spend time with him, so this is another great opportunity. Thanks for making it happen.
He especially likes to take advantage of me on the golf course, and he's made a living. I conveyed quite a bit of cash to him.
Before actually, since you gentlemen are familiar with each other, before we jump into the markets, what is it you talk about amongst yourselves in terms of discussions with your outlook of the economy, with your outlook in the markets? What do you guys talk about offline? What's on your radar?
Well, look, Dave and I see each other too infrequently, sadly, but we have a steady dialogue, and we're always talking about. I'm not sure what else we talk about other than markets. We maybe golf, Dave, but we spend all our time obsessing over what the hell's going on, trying to figure it all out. I was actually at Dave's house in the desert when the markets collapsed in 2020 in the middle of COVID. That was an interesting few days for us both. So we just talking and trying to figure out this crazy puzzle is really all we do.
Which part of this puzzle is crazy? David, care to chime in?
Well, I just want to back up. That was an amazing time. He's talking about March of 2020. And ironically, we had like a biblical strength storm that over those few days and almost flooded our house. And Grant was out there pushing water into our fire pit to keep people from coming in our house. But it was also when I remember the GDXJ, the junior miners were just getting absolutely annihilated. And Grant got me some very good intel. And as a result, we bought it and we made a ton of money when things turned around. So I'm always going to be in Grant's debt for that. But yeah, he has so many great guests on his show. So in fact, I remember this last time when we were in his area at Kiwa Island, where he spends part of his time back in October, he had James Aitken on his show. And James Aitken came up with some very important intel, which I think Grant's going to talk about regarding Japan. So I mean, Grant's got a digital Rolodex that's just like nobody I know. I don't know why he's with me.
All right, David, I'll start with you. So the S&P is right now currently at 4,600 points, give or take. Would you be selling at current levels?
Well, selling might be a strong word, but I'd certainly be, to use my sometimes explosive phrase, or at least people think it's explosive, to take profits. And when I say that, I don't mean get out, but I just think that it makes sense to be raising some cash. I'm a big believer in dollar cost averaging, which it seems like a lot of people try to implement on the buy side. Almost nobody does it on the sell side, which I think is a huge mistake. I think it's important to be humble and realize the markets can do all kinds of crazy things. So you just try to be very methodical. I mean, for example, that's what I'm doing in the oil market right now, where I sold most of my oil futures contracts as Grant knows when it was running, and now I'm methodically adding back. And I think that's how you take advantage of volatile assets. And I think the S&P is volatile, and I think we're going to have plenty of volatility next year.
Grant, can you add to that? Would you be taking profits at current levels, or would you, like some of my other guests have told me, ride the momentum up to new highs before the end of the year towards Christmas?
Yeah, I think, I was talking to someone about this earlier on today. The characteristic, I think, of markets right now is confusion. And so I think it's very difficult to really understand what's going on. Are we going to get a recession? Are we going to get a soft landing? Is the Fed going to cut? And we see payrolls this morning, which throw everybody for a loop. There's so much confusion now. And so it's very difficult to have a high conviction understanding of which way you think the market's going to break. So I think, when David talks about taking profits, I think the one thing that we can kind of pretty much guarantee going forward is that we're going to be in a period of heightened volatility, simply because there is so much uncertainty, and the two directions that the market can go in are diametrically opposed. We're either going to get market collapse that's going to bring the Fed in and rate cuts and all this kind of thing, or we're going to get this weird soft landing, maybe no landing, economic data picks up and we're off to the races again. So it's not, does the market kind of muddle around? It's the market's going to go down or it's going to go up. And so I think given the profits that you've been given, especially over the last couple of months, is we've had this crazy strong finish to the year. I think, to David's point, taking profits in a period of uncertainty when you've got gains that, if you go back to August, there's no way you're expecting to see this. It's just a prudent strategy. There are times when it pays sense to take some money off the table. And David and I have talked about this at length in the past, that the flack he gets for telling people to take profits, it always makes me smile. It made me smile again when he was talking about it then. But nobody ever went bankrupt taking profits.
Well, there's a chart here that David sent me. It's the Russell 2000 overlaid with the S&P 500. And now you see the orange line, the S&P 500 has grossly outperformed the Russell 2000. This divergence can be explained by, of course, the outperformance of the Magnificent Seven stocks amongst some other stocks in the tech sector. So wouldn't it be prudent to either take those things out, in other words, take profits on those particular stocks, David, or would you long the Russell 2000, hoping that that jaw would fold?
Well, when the Russell 2 has been down, actually, we prefer the S&P 600 to the Russell 2. And the reason is 40% of the companies in the Russell 2000 lose money, and it's only in quotes, about 20% in the S&P 600. And we've recommended that. I've recommended that in writing a couple of times when it's been down, including in October, that's, I think, a better way to play the market rebound. The other point that I've made that's sort of related to this is that if you really think the Fed's going to pause and start an easing cycle here relatively soon, the group that does the best is the gold miners. And they have been starting to perk up of late. So yes, I think the main point I'm making with this slide, and then also the one that's right after with comparing the S&P to the banking index, is very hard to have a true bull market when the small caps and the banks are so far behind the big boys. So yeah, it's the Mag 7, and then it's the S&P 493. The Mag 7's up now roughly 50% this year. The S&P 493, take a zero off there, it's up about 5%, give or take. And that's kind of a big divergence, and I don't think a healthy one. But everybody knows that. So,
Grant, following up, Grant, do you think the banks are oversold? Are they a good buy right now?
Well, I think it's very difficult to talk about banks. It's not really a case of banks. You've got to be very, very careful when you're looking at the bank sector. You've got to buy the right banks, and you've got to be careful not to buy the wrong ones. And we saw this in March. You would have thought in January that Silicon Valley Bank was a very strong bank, Signature Bank, very strong bank. And we saw what happened in very, very short order. We've seen Bank of America talk about $130 billion in mark-to-market losses in their treasury holdings. So again, it just comes back to this idea of uncertainty. There's a lot of uncertainty around. So I think, we've been through a period where you could buy banks, buy financials, you could buy the ETF and buy the sector. But I think the market now, given that confusion, given the kind of diametrically opposed outcomes, it's a period where you need to buy such and such a bank or this financial company rather than the sector, because you are going to see, to David's point about loss-making companies, you're going to see in an era of higher capital, higher cost of capital, you're going to see companies that can't make money struggle, and some of them will be in the financial sector. So owning sectors is not going to be as easy a ride as it has been for the last number of years. So I think it's kind of stock pickers market again.
Okay.
Just to check, David, if I could chime in there a little bit on the banks, I just saw an image showing the losses on government securities and bonds, basically the bond portfolio of banks, and it absolutely dwarfs what it was back in 2008-09.
Yeah.
And of course, that's because of the rise in rates and how poorly treasuries have done despite the recent rally. And of course, it was treasuries that brought down the big three banks back in the spring. It wasn't their loan book, but the loan books aren't good either. The loan books are really struggling, and I don't think this banking crisis is behind us. But also, part of your slide deck there, one of the most striking of all the ones I've got there is the concentration by hedge funds into basically the Magnificent Seven. And that's a bar chart that is right after the bank versus the S&P. I mean, it was 12% back in January 2023. Earlier this year, now it's 99%. And then I think that's what happens in January. I think that's an important message to convey to your subscribers. December is going into January are interesting because at the end of the year, the losers tend to get really dumped for tax reasons and also for, kind of virtue signaling. They don't want to have the losers on their books, on the portfolios at the end of the year. So some of these beaten up names get really cheap, and then they crowd into the winners to look good. And then very often in January, that reverses. And that's actually was the theme of my newsletter today. I think there's a real opportunity in some of these tax loss sold off victims.
Are you saying that what's happening is not really a fundamental reason behind crowding in? They're just window dressing their trades?
I wouldn't say just, but I think that's a big part of it this time of year. And also think about this. If you've got big winners like on NVIDIA, do you really want to book those gains before the end of the year? No, you want to wait until January. We're doing that with some of our stocks too. Don't take the gain this year, take it next year. But what we're trying to do, and what's worked really well over the years, is buy some of these names where, hopefully the fundamentals are good. They're just having some temporary problems, and the stocks get absolutely nuked. So it's a good time of the year to be doing some bottom fishing is my main point.
Grant, there's an extraordinary chart here on my screen. The TLT, as you know, has taken a huge losses here as the yield rose. However, huge inflows into the ETF concurrently with a drop in the price. What's going on here? Can you explain that phenomenon?
Yeah. No, I can't see the chart, unfortunately, so I'll have to imagine it. But again, look, the TLT has become a trading instrument. It's very much a trading instrument, which Treasuries was never really a trading instrument. But the ETF has allowed people to speculate on Treasuries, and that's where a lot of the moves have been. Right, that's where a lot of the volatility's been, where a lot of the movements where you can actually make some money. And so a lot of people have been crowding into the TLT as a way to play the things David was talking about there in terms of the Treasury, the volatility in the Treasury market. You're not going to be buying and selling your Treasury bonds. You're going to play the ETF. So for me, that makes perfect sense. As I can't see the chart, but I can picture it, and it makes perfect sense to me that it's attracted an awful lot of speculative capital looking to play the volatility in Treasury bonds.
Well, are investors anticipating a reversal in the yields, which is to say yields coming down, the 10-year coming down next year? Is that why they're crowding in right now?
Well, but how about Grant? To help out Grant, because he can't see it, that what's striking about that is not only that the inflows have gone vertical lately, actually they've been going vertical throughout 2023, which up until a couple of months ago was a brutal year again for bond investors. I mean, they bought into the big sell-off in 2022. So until very recently, this has been very much of a wrong way Corrigan move. And I think it's still going to be a wrong way Corrigan move despite this trading rally, because Grant and I, one thing we talk about a lot is what you and I, David, have referred to as the federal fiscal funding fiasco, my 4F scenario. And this is one where I think is really going to come back to haunt people buying long-term treasuries, assuming we do get a recession, because the amount of the federal deficit, which is already running at $2 trillion, inexcusably will go to $4 trillion. Michael Pinto, who I interviewed this week, saying $6 trillion. I think that's high, but $4 trillion is probably pretty reasonable. And are there going to be enough buyers for that long treasury debt? I think that long-term part of the treasury market right now is already very, very fragile. I think they just can't sell very many bonds there without creating a major spike in yields. But Grant, is that consistent with what you believe? Do you think that it's a lot of fragility in?
Yeah, I'd add one more thing to that, Dave, and that is the fact that obviously when you look at the highs and lows in the yields on treasury bonds, you are seeing a trading range which people have not seen in 20 odd years. And so you're bringing a lot of people in that go back on a 10-year chart and go, wow, this is 2 standard deviations away from where we've been in the last 10 years, and they'll take the other side of that trade. So you're getting a lot of people coming in that think that 4% is a crazy level, and so there's a lot more volume that's turning over in both of these. And then once it moves back the other way again, everybody's got an opinion on the treasury market. Everybody's got an opinion on the Fed. The market's pricing 3 cuts for next year. And to go back to my first point, pricing 3 cuts next year when we get the payroll number we get today, just shows you just how fraught it is to be making these big bets on something that is so murky at the moment. So it doesn't surprise me that a lot of people have been trying to trade treasury bonds, because you've finally got a trading range in them. But I think being dogmatic about which way you think this is going to go, placing all your bets and not having a sense of how you could be wrong is potentially a very dangerous thing to do right now.
I think this is a good time for Grant to respond to David Hayes' bubble 2.0 and 3.0 thesis. David, you've been on the show several times talking about, first your book, Bubble 2.0, and then you've written a follow-up, Bubble 3.0. Can you maybe just give our audience one more time a recap, your viewpoints and thesis around that, and then we'll have Grant respond to that.
Sure, I'll do it real quickly. And I think it's best to go back to Bubble 1.0, which was, of course, tech in the late 90s. And that was the biggest speculative bubble in stocks in the U.S., exceeding even 1929. And then, of course, that burst, and the Fed was under a lot of pressure to try to respond, even though it was a very mild recession. They had people like, particularly Paul Krugman, beating on him to create a new bubble, and he specifically suggested housing, and the Fed complied. They drove interest rates down to a very low level, kept them there too long, endorsed the use of adjustable rate mortgages, turned a blind eye to the extreme proliferation of subprime mortgages. So we had Bubble 2.0, which was housing. When that imploded, it almost took down the global financial system. And as a result, it was their remedial efforts, so-called remedial, to cope with Bubble 2.0 that then inflated Bubble 3.0, which I believe, and I think the facts bear this out, did a crescendo in 2021. So that's really when pretty much everything peaked out. Now, some things like NVIDIA made new highs, most things have not. You've had a tremendous loss of wealth since that time, not just with a lot of the speculative equities, but in bonds. I mean, there's been enormous losses. At one point recently, like back in October, the Deutsche Bank folks had estimated, Jim Reed, that there were $75 trillion of global bond losses. And now that's obviously shrunk, fairly significantly. Maybe it's 50 trillion, maybe it's 60 trillion. Anyway, you get these enormous bubbles and easy money. In fact, money that was where you're actually being paid in a lot of the world to borrow money. You create tremendous distortion in asset prices, and they invariably burst. Now, I would argue we're now in an echo bubble of Bubble 3.0, but they're all connected. I mean, that's important to understand the connectivity that has run between these 3 bubbles. So that is yours.
Yeah, Grant, would you agree that asset prices inflating equate to a bubble? Are we in a bubble right now with the assets that David alluded to?
Yeah, I think David's book is tremendous. I read each chapter as he published it. It's a fantastic piece of work, and David's watched all three of these bubbles, and so he recognizes what he sees, and he does a tremendous job of communicating that to people. And I think it's very easy to get swept up in these things. And it's funny when Dave talks about this bubble peaking in 2021. We're sitting here today with a lot of people talking about the S&P of 4,600, and it's tough to recognize that we peaked, a couple of years ago now, in terms of where this bubble actually reached its apex, and you only really see that looking back. And I think when Dave talks about an echo bubble, it's such a great way of thinking about it. The noise has happened, and this is just the echoes of the bubble reverberating around the kind of foothills. But there's been tremendous wealth destruction, and the fact that it was in treasury bonds, and the fact that it was in tier one assets, and people aren't being forced to mark them to market, has kind of prevented the fallout being apparent. But Silicon Valley Bank shows you what can happen when people are forced to mark those assets to market. In their event, or in their instance, it was a run on the bank, people wanting their deposits back and moving them through technology very, very quickly that forced them to sell and realize those losses. We don't know what it will be elsewhere, and I would imagine as it's treasury bonds, and we saw the Fed when they came in the wake of Silicon Valley Bank to put this facility in place where they would give people basically par for their treasury bonds. Something like that is likely to be required again, which is only going to exacerbate that 4F scenario of David. So we're in a very tricky place here. The peak of the bubble is past. There are still bubbly assets, but we haven't closed the spread between offer and bid at the moment. So there are a lot of assets that are at inflated prices, but the bids for them, which were just below the offer for many, many years, have fallen away because of the rising cost of capital. And just like people haven't been forced to mark their bond positions to market, people haven't either been willing or able to sell things like real estate at the price they're wishing to get for it. So we're in this kind of no man's land where true price discovery is very, very difficult. And what happens with the stuff we talked about at the top of the show with the Fed and the soft landing, the no landing, the recession, what happens there is likely to dictate where a lot of these assets find a clearing price. And there could be a massive gap between the good clearing price and the bad one.
That's a perfect segue. Catalyst for finding this bottom, catalyst for popping this bubble. So David, this bubble that you're talking about, what would make it pop? And we can probably go into examples of which assets may pop first. Would it be a slowdown in consumer spending? Would it be a Fed pivot, economic recession, like Grant talked about? What do you think?
Yeah, I'll go with door number 3, a recession. I think that's the big debate right now. And you get a chart in here showing the unanimity almost. I mean, it's a very high percentage of portfolio managers and investment professionals that believe we're going to get a soft landing. So that creates, I think, a very asymmetric situation, because if things do break the right way, you're not going to get much of a response, because that's what everybody's expecting. If you do get a recession, and I think the odds of getting a recession are very, very high right now. I just listened to a podcast with Danielle Deet, Martino Booth, and Adam Taggart, where she's saying we're in one right now. Now, you look at a jobs market report like today, and you go, oh, no way. But you and I've talked about this before. The jobs market is the ultimate lagging indicator. And I wouldn't pay any attention to that non-farm payroll number that came out today, because every single month this year it's been revised downward. That's telling you that they're mismeasuring it at the time of release. And I think it's because of the birth-death model, where they're overestimating business formations, underestimating business closures. What was surprising, and I think the most bullish part about the jobs number today, was the household survey, which has been usually weaker than the non-farm payroll, the official one. And it was a blockbuster, 747,000 new jobs created. Doesn't make sense to me when it's a very volatile series, but it's at odds with the fact that you've got initial claims or jobless claims rising in all 50 states right now. And I think, look at the quits ratio. You got to look at the leading indicators of the ultimate lagging indicator, which is the jobs market. So I think it's really naive of so many people when you have 19 straight months of falling leading economic indicators and the inverted yield curve that we've got, how long it's been persisting. I think the people betting on a soft landing, which is always a long shot, it's really a long shot right now. So again, you could have a very, very pronounced reaction if we get a recession.
So here's the issue with using recession as a gauge for when to sell. when the government and organizations like the NBER report a recession, they're doing so in the rearview mirror. It's already happened several months later. Officially, a recession has been designated. How can the markets react in real time? If I were an investor or a group of investors, how would they react to real-time data? In other words, what indicators would they look for in real time in order to make the assessment, all right, the economy has reached a tipping point. We're now entered a recession. It's time to sell. Grant, I'll let you take
one of the images you have are the coincident versus the leading. And that's not even the lagging, coincident versus leading. So that's clearly diverging. And I think that's a classic thing you look at. But I also think, David, let's consider the recessions that are already underway. I mean, we've had a profits recession. We've had an industrial recession. We've got a transportation recession. We've got a GDI recession. And you've got an image in there that's showing the difference between gross domestic income and gross domestic product. That's the greatest it's ever been. That's a big warning because GDI has been more accurate than GDP historically. And part of the logic of that is that income leads spending. You can't spend unless you have the income, although consumers are trying to do it now with buy now, pay later and credit cards and so forth. And we've got a private sector recession. Another one of my favorite charts you get in there, adjust GDP for the explosion in deficit spending. In other words, you back out deficit spending, this is a very weak economy, very recessionary already. So I would argue there's multiple recessions underway currently.
Okay. Grant, let's assume David is right in his analysis that there's several recessions going on already. Certainly the markets seem to be either oblivious to this fact or the markets don't care. The S&P has grinded up to near its July highs. Bitcoin, other risk assets are rising. The yields are retracing. Why is that? What's going on?
Look, a lot of that is down to people believing the Fed are going to cut rates. You know, there's this belief that Fed cuts are a great thing and they are always positive for markets. When the reality is, as David well knows, in a recession, the market's going down. You know, that first rate cut is normally the beginning of poor performance from stocks, not good performance from stocks. And you can go look at any examples you want going back. And that's just the way it is. But the market has just become conditioned to, you know, Fed cuts equal strong markets. And it's just not the case. And you know, the other thing I'd say, David, going back to your question originally there about how do market participants play the real-time data for recessions, you know, you can't. As you said, you have to take a flyer on whether if you genuinely believe we're in a recession. To your point, you won't find out until 6 or 9 months hence when the NBR says, oh, by the way, we've been in recession for 6 months. So it's a leap of faith. It's a case of looking at the data. And David's given you some great data points to look at there, looking at the consumer, looking at all the things that go into this, and then deciding whether a recession is something you need to be prepared for. And I think what David said is absolutely right. The chances of there being a recession, I think, are higher, much higher than there being a soft landing or a no landing situation. And so I think you have to skew tactically that way. You have to assume that we need to assume there's going to be a recession, and maybe start gently positioning ourselves for it in such a way that we can turn that around if it turns out we're not. But I struggle to see how we avoid a recession at this point in time. I really do. The data is hot and the data is confusing a lot of people. But given what's happened, given the what our mutual friend Steph Pomboy calls the interest rate shock rather than a hiking cycle, it's very difficult to see how the damage done by that does not end up in recession. Just because the data doesn't show it just yet doesn't mean you don't have to plan for it.
Well, do you think the Fed will step in and save the economy with renewed QE, printing money again? There's reasons. Yeah.
Go ahead. I said that's a two-part question. Will the Fed step in and save the economy? Will the Fed step in? Yes, absolutely they will. Will they save the economy? That's the question. And I don't think that a series of rate cuts this time is going to save the economy. I think that the damage to the economy has probably already been done by the very sharp, very swift rise in credit conditions, or deterioration of credit conditions, I should say. So will the rate cuts save the economy? I doubt it. Will they slow down the deterioration and ultimately provide a floor? The chances are very high they will. But I don't think rate cuts save the economy the way people have become conditioned to think that rate cuts save the market.
Well, the Fed's rate cuts, again, it's dependent on the assumption that inflation will continue to go down. Let's talk about inflation. David, where do you think inflation is headed? next year?
Oh, I think probably it'll continue to ease a bit. I think we're in a situation much like the 1970s, where the Fed did get aggressive, actually more aggressive under the much maligned Arthur Burns when inflation would flare up. I mean, he actually got raised to double digits and above inflation, which actually Jay Powell never did, at least when inflation was at its peak. But it's also a much more leveraged economy. And so I do think we're going to have this kind of stop, start, boom, bust type of scenario where inflation comes down on a cyclical basis, but it's in a secular long-term uptrend. And I think what's going to really create the next inflation leg will be the policy response by the Fed and by the Treasury, so monetary and fiscal stim, to the next recession. And I do believe, as I think you and I have talked about, that Jay Powell will not stick around for that. I don't think he will do QE again on his watch. I think he's repaired his reputation. But also on that whole topic, let's not forget that they're still tightening because they're doing quantitative tightening, the opposite of QE. That continues to go on. One of my theories is people don't pay attention to it because they don't know really how to quantify quantitative tightening. What does it equal in terms of interest rate hikes? I've heard all kinds of different numbers, but it's for sure a liquidity drain. And beyond that, it's definitely making the 4F scenario more difficult because the Fed used to be the biggest buyer of treasuries and it's now one of the biggest sellers, and it's got a lot of company. So I think that's going to be, so Michael Hartnett from BofA's got a great one-liner, which is the great shock could be that interest rates will rise during the next credit crisis at the long end of the treasury market. And I think he's exactly right about that. And that will be really shocking to a lot of people.
Grant, could you maybe respond to that?
There isn't really much of a response to that other than to say I think David's absolutely right. The conditions are pretty clear. It's just the outcome right now that's in doubt. And I think if you took people out of the moment, given what they're seeing in terms of data and what they're seeing in terms of the market, if you sat people down in the room and said, "Hey, look, here's the conditions we're seeing. What do you think?" I think it'd be a very easy call for people to talk about there being an imminent recession. Just the fact that it hasn't appeared is kind of clouding people's judgment. And look, we are wired to be optimistic. Everyone hopes we avoid a recession. Everyone wants to believe that we're going to get away with the soft landing or the no landing. And maybe we do. It's not baked in the cake, but with every day that goes by, to me, there's a much higher chance that David's absolutely right. And that, what Michael Hartnett talks about there would be a lot more than a shock to a lot of people. That would challenge a lot of people's belief systems, I suspect.
Grant, one of the scenarios I've heard on my show possibly happening is a disruption in supplies, or perhaps a rise in the oil price due to escalating tensions in Europe or the Middle East. That could elevate inflation. That would force the Fed to not cut rates next year, even if the unemployment rate were to climb up more. Do you agree with that? Could that happen? Is that something that is on your radar?
Yeah, look, anything could happen. I mean, that's I think what we need to. That's the big shift right now, is that anything could happen. Things that were previously unthinkable in terms of, the mantra of, they will never let that happen. The Fed will never let that happen. I think the big change in the last 18 months, 2 years, certainly since the Russian invasion of Ukraine, is this idea that the central banks will ultimately get what they want and they don't need to worry about market forces. They won't let that happen, or they'll step in and they'll do this. I just think that's off the table. And I think these supply shocks, I'm not so worried about any kind of demand shock, positive or negative, but a supply shock absolutely is I would say a high probability at some point, whether it is inflation related, whether it's conflict related, whether it's sanction related. The ways in which we could get supply shocks are myriad, and so I think that's a very, very strong possibility that is the thing we face, and it will lead to higher inflation, and it will lead to higher energy prices, and it will lead to the tying behind their backs of one of the arms of the central banks in terms of rate responses. So this is a brave new world that we're in now, and people need to get used to this idea that what has worked in terms of gaming the market and in terms of central bank reaction function for the last 2 decades likely either won't work at all in the next 5 years, or will have a much more muted effect.
Okay. I'd like to turn now to your preferred asset allocation strategy for 2024, given your macro outlook. David, I'll start with you. What do you think will be the best and worst performing assets? Something that we've talked about, or maybe something we haven't talked about. I'll let you pick.
Okay, well, best and worst is a little bit tricky, but I'll give it my best shot. I would say probably the things that are most detested right now, which ironically is commodities. They were very popular a year and a half or so ago, particularly when the invasion happened, but they've totally fallen out of favor. And I think what Grant was saying just a moment ago is exactly right, is that because prices have come down so severely, even for things that were considered to be bulletproof, like lithium, but copper, and you're seeing more and more evidence that we're just trying to get the copper supply. It's so difficult to develop new copper mines, and yet that demand for copper is going to go up and up and up. And oil, I mean, right now, oil is being attacked as it so often is. It seems to be the number one thing that gets hit when there are recession fears rising, which I do think is happening. I think it's been partially behind the bond rally. So, already the drilling rate count was low, and it's probably going to go lower. And the drilled but uncompleted wells, the EUCs, which have been a big prop for the production of oil. It's not the analogy I use. It's kind of like with houses, where they built a lot of houses, partly built at COVID hit, so they just stopped. And then when things got better, they were able to build those houses out the rest of the way. That's what happened with oil wells. They were stopped about halfway through, and there's been this huge backlog they've been able to drill down, but there hasn't been enough drilling, and that's going to be a real problem. I think it's just true across the whole commodity complex. So to answer your question, I think where the biggest risks are with the overcrowded areas right now, and I would put TLT in there, and I would put some of the what I call Heaven 7, the Magnificent 7 in there as well. And I think some of these tax loss candidates that we're talking about, and just to reiterate, David, because every time we talk, I give you bullish ideas. I don't think you want to be just kind of one-dimensionally bearish. I think you want to be opportunistic and look where there are pockets of value, and there are out there right now. And I think oil is one of the best, actually. And there are some oil plays. Some of the oil trusts have been crushed. They tend to be owned by retail investors. I'd be actually quite bullish on the oil trust right now, royalty trusts.
And Grant, same question.
Yeah, I think energy is definitely a place where, as today's point, I think the idea of being long a sector and just being long it is very dangerous, because you are going to get whipsawed around, I think. But I think energy is a place where you can make some money. I think the setup in the uranium market is extraordinarily bullish, but it's runs. You've got to be really, really careful and pretty tactical there. But if you look at structurally the uranium market and the shortfall in availability of uranium itself, there's a tremendous opportunity there. And look, it's boring as hell, but I want to own gold. I really do want to own gold. I think all the things we've talked about, you can make a bullish case for gold. You can make a bullish case for gold if we see inflation come back. You can make a bullish case for gold if the 4F scenario starts to gain traction and people start to worry about it to the appropriate degree. You can see gold performing well in a commodities rally, and again, I think it will continue to protect purchasing power. And we're in a period where gold went screaming through 2,100 on Monday, and it's back below 2,000 now. So you're starting to see some volatility around that triple top on the chart. But go back 25 years, and gold's basically up roughly 9% a year. CAGR over that period, and for what that gives me in terms of peace of mind, in terms of liquidity, in terms of opportunism, I love. So I think, again, it's a stock pickers market. I think saying this sector or that sector is where you should have your money is not as straightforward as it has been for a number of years. But I think if you pick the right stocks in the energy complex and you're tactical about it, and again, I like gold. And again, look, with cash rates at 5%, owning cash right now, given the stress to come in things like real estate and things like the equity markets, I think you can do a lot worse than have some dry powder and the optionality that provides you with.
Well, it also depends on your outlook for a longer-term outlook for yields. I mean, if we assume that yields will stay high, that puts tremendous pressure on equities to perform, at least to be 5%. Right? I mean, is that?
Well, you think, but we're through the looking glass now, and so people are kind of second and third guessing everything, and so those normal correlations aren't holding true. I think a lot of them will snap back into reality at some point, but for now, everybody's thinking, well, we know what the Fed's going to do. and the forward pricing of the Fed funds rate will tell you that. We know what the Fed's going to do, and more importantly, we know what will happen once they do it, because we understand perfectly how the market responds to the Fed doing X. And I think that response is going to be very different. And that's the piece I think you could see the Fed cut rates and everybody start rubbing their hands together, going, right, here we go. And the market falls out of bed and they just don't understand why. And then you get this massive catch up when people don't get what they expect. So I think it's a very fraught time to have the wrong timeline in terms of your investment horizon. And I think it's a very dangerous time to apply the logic that's worked for the last 5-10 years.
Okay. I'd like to close off.
David, can I jump in?
Please.
Because I think what Grant said there is so critically important. And he said it a couple of times, but I just don't think we can overemphasize it enough, because the market is so convinced that when the Fed starts cutting, that's bullish. And it's not just Grant and I saying, no, that's not going to happen. Look at history. History is very clear that when the Fed starts cutting, even though there could be an initial celebration, after that, the market that's when it gets clobbered. And historically, stocks don't bottom until about 60 to 70% of the way through a Fed cutting cycle. So that's a critical area where I think people are way off sides.
Certainly, it also signals that something's wrong with the economy. Otherwise, why would they cut? Which is also negative sentiment, which would prompt a sell-off. Is that the logic here?
Well, I think this is where recession versus soft landing really matters, because they can cut rates in a soft landing, and that's very bullish. So that's the critical distinction. But again, look how rarely soft landings happen, and they never happen when you've had a yield curve as inverted as this one has been. People kind of blow off the yield curve, but it works way better at forecasting the economy than any economist or the Fed. Certainly, the Fed's never predicted a recession in advance. You've got Janet Yellen, whose track record's terrible, saying it's going to be a soft landing. So I would rather bet on the yield curve than all those other folks.
I'd like to close off on the nation's debt level and what's going to happen because of that. The deficit totaled $1.7 trillion. The federal debt is above $30 trillion. It's the largest in the world. Currently, the debt to GDP in the U.S. is above 120%. According to this table, the U.S. occupies 34% of global debt. What is the government going to do about it is my question. David?
Well, first of all, I'd say that if you look at that image, it's $2 trillion because of the way they played with the student loan debt forgiveness. So that the deficit's basically going from $1 trillion last year to $2 trillion this year, which is, again, I think it's just inexcusable that that's happened. And people want to know why the economy has been doing well. Well, that's actually your number one go-to right there. So yes, I think it's a huge problem, and it's going to get more difficult as the entitlements, which have been ignored for so long, well, now they've got to be paid for. And that Social Security trust fund, Medicare trust fund, that all it has is government debt in it. So that's really not real money. To me, it just looks like a terrible collision coming up. But Grant's much more of an authority on this than I am.
Yeah, Grant, what does this mean to you? Does this have any market impact, the ballooning debt? In other words, why should we care about these figures?
Well, look, this is the crucial thing, right? Because of course it matters. It matters a great deal. It just hasn't yet, and that's down to confidence. You've got, on the one hand, you've got the law of large numbers in effect, where these numbers are so big now that people don't really sit down and think what they mean. But reality will assert itself, and at some point, for some reason, the financial situation of the United States is going to matter, because the dollar is the reserve currency, and everybody's invested in that, whether they like it or not. If they consume energy, they've got dollars on their balance sheet. And so $33 trillion in debt is going to matter. And I would think more importantly in the short term, this $2 trillion that David's talking about heading to $4 trillion is absolutely going to matter, probably more so than the $33 trillion in debt. And when it does, it will matter a great deal for the stock market. It'll matter a great deal for the bond market, particularly the treasury market. It'll matter a great deal for the dollar. We just haven't seen it yet. And the most dangerous part, I think, is the fact that it's crept up to these levels, and we've seen the total debt owned by the public go up $10 trillion in the last handful of years, and it hasn't mattered. And the big danger here is that people assume that because it hasn't mattered, it won't matter, and that's absolutely not the case. And it's impossible to say when it's going to matter. It's impossible to say what's going to be the trigger. But at some point, there will be a reckoning here. And when the reckoning comes, the US's financer is in absolute tatters. And that's going to matter. And it's going to be a huge negative shock for risk assets, the currency, the bond market, all of it. It just isn't yet. And I think for a long period of time, it's been okay to just blow off that $33 trillion of debt. And it's been okay to blow off and say deficits don't matter. And we've heard that before from government officials in David and I's day. And for a period, that's right, they don't. But at some point they do. And when they do, they're never going to have mattered more than they will this time. And it's going to be ugly.
I can't help, final question for you, Grant, and I'll end it here. I can't help but notice there's an indirect correlation between the rising debt and rising asset prices. I suppose one way to look at it is if the Fed needs to monetize some of this debt to pay it off, well, they have to expand their balance sheet. That's good for assets, right?
Yes and no. It's good when everybody thinks of it in those terms. It's really bad when people start to think how they're undermining the value of the currency. And so, yes, because you get nominal asset price rises, possibly, but in a world where that is happening because the dollar is losing its value at a precipitous rate, it changes the picture considerably. And so, like I said, I keep coming back to this idea that there is so much confusion here, and there is so much potential for heightened volatility in these markets that everybody needs to be incredibly vigilant. And when you're starting to be vigilant, these things that haven't mattered will, I suspect, matter sooner.
Okay, excellent. Well, thank you very much, gentlemen, for being here. David, where can we learn about you and follow your work?
You go to Haymaker _ at Substack. And David, it's always a pleasure to be with you. Thank you very much for the invite, and congratulations on how well your channel's doing. I'd say you're a rock star, but that's kind of that commercial makes me feel bad about saying that to you, but you really are.
No, it's because of guests like yourself that we've had a good program. So thank you for coming back. And Grant, it's a pleasure to meet you. Where can we learn from you and follow your work?
Likewise, David. Thanks for having me, and always a good pleasure to see you again, Mr. Hay, my dear friend. Very simple, grant-williams.com. Everything you wanted to know is there.
I'm just curious, why did you name your newsletter things that make you go, Is that it speaks for itself, but there's an inspiration behind the name, certainly, right?
No, that was the idea. Can I present you with things that will make you think? And so that's what I've been trying to do for the last 15 years.
Okay. He does it right well.
All right. Well, definitely check that out and make ourselves think. Thank you very much, Grant and David, for being here. Appreciate it once again.
Thanks, David. Have a great weekend.
You as well, and thank you for watching. Don't forget to follow both Grant and David in the links down below, and don't forget to subscribe.